Robinhood has had a turbulent couple of years and the stock is down over 70% since its IPO. At the current share price under $10, the company has a market cap of $8.4 billion, but Robinhood has got over $5 billion of corporate cash on its balance sheet and little debt, so the enterprise value is only $3.2 billion. That's less than 2 times annual revenues. Adjusted Ebitda over the last 12 months is also positive at $395 million, which gives the company a valuation of only 8 times Ebitda. But Robinhood stock is not quite as cheap as it sounds. The company has got $5.2 billion of cash, but it needs to safeguard some of that in case something goes wrong. After all, a lack of collateral almost destroyed the business during the GameStop short squeeze in 2021. The company had to find around $3.7 billion to stay in business. So let's assume Robinhood actually has around $1.5 billion of excess cash. That means the stock is more realistically valued at 4.1 times revenue or 18 times Ebitda. Meanwhile, annual revenues are still 8% below their 2021 peak, and monthly active users have more than halved. But it's worth bearing in mind 2 important points. First, the equity markets in 2021 went completely crazy, so it's not surprising that Robinhood has experienced a slowdown in growth, especially with the increase in interest rates. Second, those higher interest rates are now significantly boosting Robinhood's revenues. Net interest revenue soared to over $700 million, and that figure is going to increase further over the next 6 months. Looking at the bigger picture, this is a company that has grown to over 23 million users and $1.7 billion of revenue in only 10 years. Interactive Brokers, by comparison, has only got 2.4 million accounts while maintaining a higher market cap. And Robinhood has plans for its customers. It's moving into retirement products and credit cards that can further boost revenues. Let's assume Robinhood gets to $530 million of adjusted Ebitda this year and is able to grow that figure 8% a year for the next 5 years. That would lead to roughly $800 million of adjusted Ebitda in 5 years' time, and a 20 times multiple puts the valuation at around $16 billion, which works out to an investment return of roughly 18% per year. That looks like a good return, but the risk is that Robinhood's brand has been forever tarnished by the events of 2021, and that could affect the performance of the company's new products. But there's a sense that Robinhood might have weathered the storm and come out the other side, which is why I'm giving the stock a bullish rating, but these are my personal opinions, not financial advice, and I have bought shares in Robinhood. For more detailed investing ideas, check out our website at overlookedalpha.com.